Hello everyone, hi Professor. I'm Tim Huang from Team 11. So in this presentation, we're going to talk about the asset allocation strategy under the impact of the COVID-19, which have a crisis influence on the capital market in this tough time. The outbreak of coronavirus caused global attention with immediate upward shocks on the capital markets, the crude oil, gold, future stocks. The global capital market stumbles, and investors are retreating from investing. Asset diversification and smart trading long across the market as traders tend to avoid COVID-19 risks. Therefore, this presentation explores the impact of COVID-19 outbreak on allocation of finance assets by different investors in global markets. So now I'm going to talk about how the capital market goes so far. So the global capital market has been experiencing a tough week since the eruption of the coronavirus in China, followed with a spread to other countries such as the US and the UK. So the Nasdaq index achieved like the 1920 then dipped to the 8800, but recovered back to the 1900 recent days because of the crude oil market. Also, the virus has been controlled. Based on the global news, the rate of COVID-19 infection cases in the world is reducing, which is a good news to the investor. However, the rate of increase in new cases in the United States are alarming, which is making it very concerning to the investor. So we can see here the curve of the United States is really incredible. It's really beyond other countries. So the asset market never seems to be pricing on attractive to invest, due to the toll from the coronavirus. However, the coronavirus outbreak has had a considerable impact on the asset allocation. So, did this coronavirus occur before? Sure, this emergency isn't the first. Coronavirus had already erupted in China in 2002 to 2003, spreading to the rest of the world at the quantifiable velocity. The previous eruption affected 29 countries with 8,000 cases reported. Therefore, it is a concern to capital investors as it poses global risks. And its eruption has destabilized the global flow of goods and service. This had made it strenuous for investors to venture into various portfolios. Its impact has affected not only the capital markets but also the entire product market and reduced the flow of goods and service. So now I'm going to talk about the impact of COVID-19 when it finally happened and when it happened fast. So when the coronavirus outbreak in China in entirety reached the global news desk on the 21 January, the global capital markets such as the JP Morgan observed a reduction of the Brent crude with the negative 21. Since then, well, that of gold increased like 5%. Especially, the price of the United States oil has turned negative in the recent week, which is the first time in the history. Also, the increasing cases of coronavirus infection in Italy has an impact on the Italian stock market. Perhaps its index has precipitated a negative 15% decreasing from the 20th February. So these significant global participants in the supply chains, such as the Japan and the South Korea, has also experienced the same menace, which further crystallized the asset allocation market, making a decline of negative 12% in the KOSPI since the peak before the offset in the February. None of the investors would like to bear out the risks associated with COVID-19, since S&P is likely to go out for a while as the economic waits to normalize. So we can consider the table below here, which indicating the value of correction since 1918 on the time of the COVID-19 outbreak. Due to the quarantine and restriction to gathering, and all other stuffs. The investors have had negligible sales with only less than 3% of the total stocks in the S&P 500 trading above their average.
Diversification strategy. During this COVID-19 pandemic, investors need to be vigilant in their diversification strategy. They should not under-diversify or over-diversify because the extremes of under-diversification or over-diversification proposes a risk to their portfolio management. Investors should look to sell assets that are underperforming and hold on to assets that are stable. Investors are scrambling to reach their financial goals and get high returns on their investment. Most investors are using bonds to help diversify their portfolio and smooth out the market ride. The strategy that has been working so far by multiple investors includes reducing equity overweight, elimination of corporate high-yield trust bonds, and adding cores to trust bonds. For instance, other firms such as insurance companies may opt not to have protection but are sure that nothing will go wrong in the long run. They have devised various mechanisms to pointedly reduce the market risks for a period, for example, 12 to 18 months. Furthermore, despite market volatility, the performance of bonds has indicated positive growth during the period of the coronavirus epidemic. The performance chart below indicates historical performance since the onset of coronavirus.
The summary of our asset allocation strategy is that the coronavirus-19 has altered the cognitive paradigm of the capital markets due to uncertainties. Everything could change and exceed our imagination. As such, both long-term and short-term investors are risking vast. They should be more careful than ever before. While smart investors can always find good opportunities in the risky market, most of them have focused on the various financial strategies that can help them in diversifying their portfolios, such as access to uncorrelated or even negative correlated streams of returns. This method can help them to offset the risk to survive in a risky market. As we already knew that the financial markets have marked the low performance when the US 10-year Treasury bond yield began at its lowest since December 2018. Therefore, it is advisable that the majority of the income-focused investors adopt the expansion strategy, such as investing in real estate, high-quality bonds, and equities that pay high dividends within this time of the coronavirus-19 outbreak. Moreover, they should plan for stocks or bonds as it indicates a probable increase in earnings soon. Here are our references. That's all. Thank you.